It's Mel with the Mark and Mel team, eXp Realty. And so let's see what's gone on since the end of 2022 and throughout January. Some crazy good news, maybe. So we'll check it out and see how it may impact us in the next couple of months. And what we saw, of course, when interest rates went up, we saw a dramatic decline in appreciation, and the prices dropped because so much demand from buyers dropped, and that led to more and more competition between sellers and everybody trying to get their home sold and having to lower their prices. You can see here that the monthly average stayed basically level from December to January. You can see where the decline started in May and June, and the price per square foot was dropping and dropping and dropping. And then we got to a point in December and the interest rates improved. And because of that, there was some buyer demand, people that hopped in once those prices got down to a more reasonable amount. The buyers saw that the interest rate dropped and they hopped back into the market. So you basically have this flat time, no appreciation, no depreciation, stayed steady between December and January. And you see that the annual appreciation absolutely was changing. So it was curving and flattening out into a more stable appreciation, not hyper appreciating anymore. So when you look at the overall last 12 months, you can see where it just kind of curved and started flattening out instead of continuing upward. Now, how is this going to impact home sellers and home buyers? That's what we want to know. But there was an exit of where you see these orange, bright orange. There was less people migrating in and more moving out. So that in and out ratio is the proportion of inbound versus outbound moves for the city or state over the course of the calendar year. So you can see we increased, and that increased our demand as people left California. They had extra money to put down more cash and compete for those prices. So that kept our market fairly strong, even though we did have that decline in price when the interest rates went up. When you look at United Van Lines, their reports show the same thing. And North American moving service, you see the same thing. A lot of people, high outbound in California, high inbound in Arizona. Here's the market cycle and where we are. We're pretty much still in skepticism. People don't know whether the market's actually improving or not, because we did have a lot of buyers that hopped in at the end of the year when those interest rates dropped. They were just ready to go, but you do have a lot of large iBuyers that are exiting the market. Zillow's not planning on buying a lot of homes. You have OfferPad and Opendoor not planning to buy a lot of homes. They're trying to sell the inventory they have. So you still have that skepticism. So we do hear about the layoffs, and that creates some skepticism. This shows the contract ratio, and you can tell that since October, there's been a lot less that went under contract. So that is down, as well as inventory. A large part of this is due to seasonality, because you can see there's a typical pattern. When you come to the end of the year, it does slow down. So it slowed down dramatically the end of 2022. So this is the current for supply versus demand. Our supply is very low, so that usually means a higher demand, but because of the high interest rates, still demand is low. So you're really seeing more of a balance. So we're in this balance area of 103. And, actually, when it gets up to 110, you're back into a seller's market. So we've gone from starting to go into the red and being more of a buyer's market. We were a buyer's market for about 4 weeks there. And then we since then have had this bit of activity that has pushed it more into balance. So we're at 103.2 as of January 8th. So we'll see where that goes, if it continues to be balanced, or if there's a large amount of homes that go on the multiple listing service, because people usually sell and it picks up during spring. So we'll see what happens as we go into spring and whether it'll get closer to sellers or buyer's market again. But right now we're right in balance. And that means even though we have some longer market times, that home sellers are being really reasonable with their pricing, and the homes are selling then. And even though the buyers are negotiating and kind of putting their foot down also because they don't want to overpay, not knowing where this is going to go in the next several months, whether there'll be another drop or whether it will stabilize. And they want to jump back in now to take advantage of the lower rate, the lower interest rate. This shows right here, this was the 4-week buyer market, and that was it. And you can see there it was going down below the balance market. Now it's kind of headed upward into possibly a seller's market. Again, like I say, as more and more people list their homes in the spring, that might bring it back down to balance, or even possibly a buyer's market again, because there's more options and more inventory, and then there's more competition from sellers to attract those buyers, and sometimes they'll lower prices to attract those buyers when they're competing to sell their home. So you can see here, we're doing this dance between the balance between a little slight buyer's market and a slight seller's market. And you can see right here, if you were to blow that up, this is right here is the little bit of the buyer's market that there was. And you can see in the past when there was little buyer's markets, this is a big buyer's market, but overall, this was a tiny one right here. And it was a long dance here between the beginning of 2014 and 2015. So that was a long dance of balance. And then it turned back into a seller's market from 2015. Of course, it was a nice balanced seller market. So we bought and sold property, and still always did very well with that during that time, and improved properties. And if we decided to sell it, we purchased something else, and we made money off of that sale of that home because we improved its value. So here is the Crawford Market Index in showing the seller's market here from 1 to 5. You see Fountain Hills, Paradise Valley, Cave Creek, Chandler. That's now become a seller's market again. Scottsdale, these ones with the exclamation mark, they are cities that turned back into a more balanced and a more seller's market. So that's showing these green arrows upward and going the other direction past the 100 in the positive direction. And Tempe turned into a more of a balanced market from a buyer's market. Mesa went from a buyer's market to a balanced market. Avondale went from a buyer's market to a balanced market. And Gilbert stayed the same, a balanced market. And you still have more of a buyer's market in those outskirt areas like Peoria, Surprise, Goodyear, especially in Queen Creek, Maricopa, and Buckeye. So you can imagine there is still a lot of buyers on the sidelines. And when will rates go down? A lot of them are wondering that, but some of them are not waiting. They're not waiting. They're utilizing seller concessions. They're utilizing any rate buy downs from the seller, and they are hopping into the market. So mortgage rates, where will they go? Nobody really knows. We'll hear in the first week of February what the Fed does to the rate, and We'll also hear the reports of job claims, unemployment, and that will play a part in what they do and how they think we're improving or whether we're going into the recession. And the majority of mortgage types, there's still a large percent of cash, 26% cash, 54% are conventional loans, 14% FHA loans, and 6% are VA loans right now. If we drop, what if the median prices decline 3.5% over 2 months and the mortgage rate declines to 5%? You would basically be back to a payment of what it was Q2 of 2021. Pretty much. That was 1863 then, as of January and 2021, and that would mean a payment of about 1858, so a little bit lower. So that's the thing we have to watch, because if prices drop a little more and the interest rates go down, that will be much more affordable, and you will see more buyers hopping in to take advantage of that, just like they did in Q2 of 2021. Still have a large percent of non-iBuyer losses. So these are non-iBuyer losses, just regular flippers that tried to make a quick dollar, but they have taken a big loss from June to November. Same with this one. This is offer pad losses around Arizona, and this is Open Door, which Open Door had the biggest percentage of home value losses, which they recorded sale prices less than the recorded purchase price. It's Mel with the Mark and Mel team, eXp Realty, and we are just about a week away from February 2023.